As artificial intelligence processors scale to mind-bending speeds, the industry is slamming into a terrifying wall of basic physics. Next-generation AI chips are now exceeding 1,000 watts of power draw individually. At these extreme energy levels, traditional lateral power delivery is physically failing. The copper traces on standard motherboards simply cannot handle the massive current required without catastrophic power loss and overheating. Today, we are diving deep into Vicor Corporation. Ticker, VICR. This engineering juggernaut does not build the AI chips, they build the proprietary technology that physically allows those chips to turn on. Vicor designs and manufactures advanced factorized power architecture and vertical power delivery modules that supply immense electrical current directly underneath the processor die. While mainstream retail screeners mistakenly classify them as just another cyclical electronic component manufacturer, deep fundamental analysis reveals a company that holds a literal patent and engineering chokepoint over the high-density power delivery required for modern AI silicon. Let's break down why their backlog just surged to $380 million, and why Wall Street algorithms are completely mispricing this intellectual property fortress. To accurately calculate the barrier to entry here, you have to understand the sheer complexity of the last-inch power problem. For decades, data centers delivered power laterally, routing electricity horizontally across the motherboard from a voltage regulator to the processor. But electrical current traveling through copper faces natural resistance. When you force 1,000 watts of power through lateral traces, that resistance creates massive I²R power loss. The electricity turns into destructive heat before it ever reaches the processor, starving the AI chip of power and forcing the cooling systems to work in overdrive. You cannot run a multi-billion-dollar hyperscale cluster if your motherboards are melting. The industry has reached the physical limit of lateral architecture. Hyperscalers and original equipment manufacturers cannot solve this by simply upgrading software or buying bigger fans, they have to completely re-engineer how electricity enters the semiconductor. This is where Vicor completely separates itself from legacy power management competitors. They bypass the lateral copper traces entirely by engineering factorized power architecture. Instead of sending power sideways, Vicor's modular components allow system architects to place the current multipliers directly underneath the processor socket. This is known as vertical power delivery, or VPD. By pushing the power straight up into the die, they virtually eliminate the copper trace resistance, drastically reducing power loss and lowering the thermal footprint of the entire server rack. In their recently announced second-generation vertical power delivery systems, Vicor has achieved current density up to an incredible 5 amps per millimeter squared. This proprietary technology places them years ahead of first-generation copycats. They are not just supplying a generic commodity component, they are providing the absolute physical nervous system required to unleash the maximum compute power of modern AI data centers. Having the best engineering in the world is useless if cheap overseas competitors can legally clone it. The fundamental disconnect in the market right now is that algorithmic bots are missing the massive legal and commercial inflection point Vicor just achieved. After years of fighting foreign infringement, the U.S. International Trade Commission issued a limited exclusion order explicitly banning the importation of power modules and unlicensed computing systems that infringe on Vicor's patents. This landmark ruling effectively blocked massive contract manufacturers and foreign competitors from bringing copycat systems into the United States. The result? Hyperscalers and OEMs were forced to either sign direct licensing agreements with Vicor, resulting in hundreds of millions in expected royalty revenues, or buy Vicor's hardware directly. This regulatory and intellectual chokepoint just drove an explosive Q2 2026 earnings beat, highlighted by a record $380 million one-year backlog. The bots are looking at historical volatility, while the smart money is tracking the massive licensing moat that just locked down the AI supply chain. When you overlay these operational victories onto our quantitative dashboard, the model reveals an absolute fortress. The fundamental data assigns Vicor a flawless AAA Prime Stability rating, backed by a mathematically verified 100% survival chance. Let's look directly at the underlying capital vault supporting this operation. The company's Altman Z-Score stands at a staggering 21.44. This places them incredibly deep inside the financial safe zone, completely obliterating any statistical risk of near-term insolvency. This elite financial health is anchored by powerful bottom-line execution. Vicor generates a highly profitable net income of $70.4 million. More importantly, the core business model is translating those sales into hard liquidity, producing a strong, positive operating cash flow of $30.2 million. They have the organic cash generation required to continuously fund the heavy research and development necessary to maintain their technological lead without relying on toxic debt. Navigating the capital-intensive semiconductor and power delivery sector usually requires management teams to constantly tap the equity markets, destroying shareholder value in the process. VICR is the absolute exception to this rule. Our fundamental dashboard tracks a pristine annual share dilution rate of exactly 0%. Management has demonstrated incredible capital discipline, refusing to dilute existing shareholders to fund their expansion. Instead, their historical profitability has allowed them to stockpile a massive foundation of wealth, carrying a highly positive accumulated deficit, meaning retained earnings, of $491.8 million on their balance sheet. To protect this wealth from macroeconomic shocks, they have built an impenetrable short-term liquidity shield. The dashboard exposes a towering current ratio of 13.25x. This means the company holds more than 13 times the short-term liquid assets required to completely wipe out their immediate financial liabilities. They are a masterclass in compounding real-world industrial profits. When assessing their long-term competitive moat, our fundamental dashboard reflects the undeniable reality of holding an architectural monopoly. VICR scores an elite 4 out of 5 for intangible assets. This is not just a brand name, this is an extensive vault of intellectual property, highly specialized engineering expertise, and enforced patents in high-performance power management that competitors legally cannot bypass. Because their vertical power modules dictate the physical layout of the entire motherboard, they also command a massive 4 out of 5 for switching costs. Once a hyperscaler engineers a multi-million-dollar AI server cluster around VICR's proprietary VPD architecture, the redesign, requalification, and testing costs required to rip it out and switch suppliers are practically insurmountable. This deep architectural integration supports a powerful 4 out of 5 for pricing power. Because they provide a unique technological advantage that dramatically increases the efficiency of $1,000 AI chips, they can command premium pricing. While their B2B model scores a low 1 out of 5 for network effect, since component supply doesn't inherently scale via user adoption, their physical hardware lock-in guarantees a deeply sticky, high-margin revenue pipeline. Vicor Corporation holds the physical, intellectual, and architectural choke point for next-generation AI power delivery, and while retail screeners dismiss the stock as just another cyclical component manufacturer, deep fundamental analysis reveals a AAA Prime Stability powerhouse operating with a flawless 0% annual share dilution and generating $70.4 million in highly profitable net income. Shielded by an elite 21.44 Altman Z-Score, a towering 13.25x current ratio, and a massive $491.8 million in retained earnings, the company is executing flawlessly on its capital allocation. By leveraging the U.S. International Trade Commission bans to enforce a formidable 4 out of 5 intangible patent moat, management has locked hyperscalers into their vertical power delivery systems, driving a massive $380 million backlog and ensuring that the structural advantage of their high-density architecture remains completely unmatched. Is this proprietary powerhouse the ultimate vehicle to capture the artificial intelligence hardware supercycle, or do the realities of the cyclical semiconductor supply chain present too much friction for your portfolio? Let me know in the comments. For all the tools, financial dashboards, and deep dive analytics utilized in this video, check out the link to www.stock-teller.com in the description below. Remember, this is not financial advice. You're watching Stockteller, where every ticker has a tail.